Hello, everybody. I'd like to welcome you to our live market analysis webinar. But before we start, let me ask you to confirm that you can see my screen with the webinar name and you can hear me properly. So if you do hear me and if you see my screen, please type yes, Y, or plus sign in the chart section. Once again, guys, if you can hear me properly, please type yes, Y, or plus sign in the question section. I do receive some confirmations, but not a lot of people have confirmed that they can hear me. So please go ahead and type Y, yes, or plus sign in the chart section. All right. Okay. I guess we have enough confirmations to start a webinar. All right. Okay. Um, what I'm going to be doing is before we start the webinar, let me introduce myself. My name is Yury Safronau. I'm an A2ZMarkets.com chief currency strategist and the person behind the daily free Forex signals on A2ZMarkets.com. I have a PhD degree in finance and I work as an independent equity manager. I have extensive experience in trading stocks, crypto, and Forex since 2009. First of all, I'd like to tell you that this webinar is sponsored by Forex4you, and let me briefly introduce you the company. eGlobal offers two main services: online trading on more than 150 instruments under the brand name of Forex4you, and copy trading investment services under the brand name Share4you. Before we start the webinar, let me briefly mention the disclaimer. Any opinions made may be personal to the author and may not reflect the opinions of Forex4you. All expressions of the opinions are subject to change without notice. This material is considered a marketing communication and does not contain, nor should not be construed as containing, investment advice or an investment recommendation or an offer or solicitation of any transaction in financial instruments. Forex4you makes no representation and assumes no liability as to the accuracy or completeness of the information provided, nor any loss arising from any investment based on a recommendation, forecast, or any other information supplied by an employee of Forex4you, a third party, or otherwise. All right. We've finished with the official part of the webinar, and now let's start from the educational one. I'd like to mention that usually before the webinar, I do provide some educational information regarding the instruments I use to analyze market and to make decisions on which trades to use and what instruments to use and so on. So I would also like to spend like 10-15 minutes with you on the like technical basis on spending on the instruments I use to make decisions and to analyze the market. So we're going to be learning these instruments for about 10-15 minutes, and after that we're going to jump to the live market and analyze live market, whichever currency pairs you want. And we have 9 basic currency pairs, but if you want more, we can analyze more. But before that, let's do the educational part. All right. I'd like to tell you that we are going to analyze market with the help of supply and support and resistance lines and moving averages. So before we start, let me briefly describe what support and resistance lines are and moving averages and how to use them. So the concept of support and resistance are undoubtedly two of the most highly discussed attributes of technical analysis. part of analyzing chart patterns. These terms are used by traders to refer to price levels on charts that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. As the price of a currency pair drops, demand increases, thus forming a support line. Resistance zones arise due to sell-off when prices increase. So once an area or a zone of support or resistance has been identified, it provides valuable potential trade entry or exit points. This is because as a price reaches a point of support or resistance, it will do one of two things: bounce back away from the support or resistance level, or violate the price level and continue to its direction until it hits the next support or resistance level. Most forms of traders are based on the belief that support and resistance zones will not be broken. Whether price is halted by the support or resistance level or breaks through, traders can forecast on the direction and can quickly determine if they are correct. If price moves in the wrong direction, the position can be closed at a small loss. If price moves into the right direction, however, the move may not be substantial. The key support and resistance levels are simply zones where prices on the chart have found it difficult to fall below or above, and often rejected any attempts to break those levels. Because of these reactions, they refer to key areas of the chart where institutional traders are likely to buy or sell their investment, take profit, or place their stop loss around. Support and resistance levels can be formed in 4 different ways: psychological support and resistance, pivot support and resistance, price action support and resistance, and moving averages. So psychological support and resistance zones occur as a result of traders using price levels that end in round figures, such as 00 or 1.1500 or 1.20, like in this example, or 110. So most inexperienced traders tend to buy or sell assets when the price is at a whole number, because they are more likely to feel that the currency pair is fairly valued at such levels. Most target price stop orders set by either retail investors or large investment banks are placed at round price levels rather than at price such as 1.2015. Because so many orders are placed at the same level, these round numbers, let me scroll it back to psychological support levels. So most traders set their price stop orders at round levels rather than at prices such as 1.2015. Because so many orders are placed at the same level, these round numbers tend to act as strong price barriers. If all the clients of an investment bank put in sell orders at a suggested target of a price, for example, 121, it would take an extreme number of purchases to absorb these sales, and therefore a level of resistance would be created. So how to identify psychological support and resistance areas? This is very easy. The trader looks for areas where the price of the asset ends in round figures, and then checks to see if this area has been respected by a support or resistance in the recent past. All right. The next one is pivot point support and resistance. Pivot support resistance are calculated by the application of pivot points, which has been used by flow traders and professionals for decades. Pivot points are calculated from the previous day's highs, low, and closing prices. Using pivot points, there are 3 levels of support: S1, S2, and S3, a central pivot point, and 3 lines of resistance: R1, R2, and R3. On this slide, you can clearly see how price action reached to the zones of support 1 and support 2 in here, okay, and approached further and faced a resistance in R1 and R2. Unfortunately, there are no letters R and S on this slide, but basically what you need to know is that the pivot point indicator, it puts a central line in here, the blue one, and above the R1, R2, and R3 zones, and S1, S2, and S3 zones below the central line. So what it creates for you, 7 lines, which the price basically respects when moving up and down. And you can clearly see how the price in this slide, it faced a resistance in here, then retraced a little bit, broke the resistance 1, went to the resistance 2, faced strong resistance, and retraced back to the resistance 1. So basically you can use those levels in order to predict the market moves for the currency pair or a commodity, and basically put your targets or stop levels either above or below those pivot points, support and resistance zones. Okay. How to identify pivot points? Rather than go through the complex pathway of trying to calculate pivot points using the previous day high, low, and closing prices, a trader can use any of the pivot points indicators, which is automatically draw pivot points on the chart. So basically what I would suggest is you go download a special indicator, which is called pivot points, and integrate it into your MetaTrader or any other trading terminal. And you simply click on the button and it would automatically calculate it for you. As well, there are pivot points calculators on different websites, and you can go ahead and also input the data in there. But in order to calculate the pivot points, you need to know the high, low, close, and open price of the day. So that's you need to input it manually, so which is not really great. So indicator is much better and faster and easier as well. All right, the next is price action, support and resistance. The price action can also determine where support and resistance occur. If a particular price level has functioned as a support or resistance level in the recent past, it's likely that traders will respect those levels when prices approach them, as the sentiment at the time may indicate a recent support or as an oversold area, or a recent resistance as an oversold area. On this slide, you can see areas that price action formed support and resistance levels. We can also see that the region that used to be a resistance area eventually became a support area when it was broken. Like in here you see, right? A resistance was broken and it became a support. So incidentally, that was also almost a psychological level of 1300, almost 1300, where the price of an asset formed a round figure. Since support and resistance levels define areas where buyers and sellers of the asset enter and exit trade positions, they are important when determining entry and exit points based on support, resistance, trade strategies. So how do we identify those price action, support and resistance? The quick way to identify those levels is to scan the charts to see areas where prices have formed recent support and resistance levels. If a bullish run terminates at the price levels and retreats before assuming another bullish run that terminates at the same price, then this is a resistance level. As long as that level holds, it serves as a resistance, and when it's broken, it becomes a support. Okay, so how to find entries with the support and resistance. The basic trading method of using support and resistance is to buy near support in uptrends, ranges or chart patterns, and to sell short near resistance in downtrend ranges and chart patterns. It helps to isolate a longer-term trend even when trading a range or chart pattern. The trend provides guidance on the direction to trade in. For example, if the trend is down, but then a range develops, preference should be given to short selling at range resistance instead of buying at range support. The downtrend lets us know that going short has a better probability of producing a profit than buying. If the trend is up and then a triangle pattern develops, favor buying near support and triangle pattern. Buying near support or selling near resistance can pay off, but there is no guarantee that the support or resistance will hold. Therefore, consider waiting for some confirmation that the market is still respecting that area. So if buying near support, wait for a consolidation in the support area and then buy when the price breaks above the high of that small consolidation area. Like in here, you see the consolidation area. In here, the buy signal we received after the price broke this upper border of the consolidation area. So when the price makes a move like that, it lets you know that price is still respecting the support area, and also that the price is starting to move higher of support. The same concept applies to selling at resistance. Wait for a consolidation near the resistance area, then enter a short trade when the price drops below the low of the small consolidation. I'm sorry. When buying, place a stop loss several cents below support, and when shorting, place a stop loss several pips above resistance. If waiting for a consolidation, place a stop loss a couple pips below the consolidation when buying. When selling, the stop loss goes a couple of pips above the consolidation. When entering a trade, have a target price in mind for a profitable exit. If buying near support, consider exiting just before the price reaches a strong resistance level. If shorting at resistance, just exit before the price reaches a strong support. You can also exit at the minor support and resistance levels. For example, if buying at support in a rising trend channel, consider selling at the top of the channel. In some cases, you may be able to extract some profit if you let the breakout occur. Instead of selling at minor support resistance, for example, if buying near triangle support within a larger uptrend, you may wish to hold the trade until it breaks through triangle resistance and continues with an uptrend. All right. So there is another approach as well. Some traders prefer to buy when price comes close to support level, either directly on the level or close to it. They use very tight stop loss, several cents below support, and take profit level which is 5-10 times larger than stop loss. In this case, even if your position is closed by stop loss, you don't lose a lot. But in case of retracement, you can catch all movements from the beginning. There is also a concept that old support can become new resistance or vice versa. This isn't always the case, but does tend to work well in very specific conditions. Okay. Most technical traders incorporate the power of various technical indicators such as moving averages to aid in predicting future short-term movements, but these traders never fully realize the ability these tools have for identifying levels of support and resistance. As you can see from the chart below, a moving average is constantly changing line that smooths out past price data while also allowing the trader to identify support and resistance. Notice how the price of an asset finds support at the moving average when the trend is up. Like in here, in here, in here, in here, in here, and in this 50 moving average as well. Like it acts like a dynamic support, and every time the price approaches the moving averages, it finds a support and moves up. Okay, Traders can use moving averages in a variety of ways, such as to anticipate moves to the upside when price lines cross above a key moving averages, or to exit trades when the price drops below a moving averages. Regardless of how the moving average is used, they very often create automatic support and resistance levels. Most traders will experiment with different time periods in their moving averages so that they can find the one that works best for their specific task. So basically, how do we use moving averages? How should they be used? The moving averages lack current price action because they are based on past prices. The longer the time period of the moving average is, the greater is the lag. The 200 moving average will have a much greater degree of lag than a 50-day moving average because it contains prices for the past 200 days. The length of the moving average is use depends on the trading objectives. When shorter moving average used for short-term trading and longer-term moving averages are more suited for long-term investors. The 50-day and 200-day MAs are widely followed by investors and traders, with break above and below this moving average considered to be important trading signal. Moving averages are important trading signal on their own, or when two averages cross over. A rising moving average indicates that currency is in an uptrend, like you saw on the previous slide in here. All right. And declining moving averages indicate that it's a downtrend. Similarly, upward momentum is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a longer-term moving average. Downward momentum is confirmed when a bearish crossover, which occurs when a short-term moving average crosses below a longer-term moving average. So basically, how do we use the moving averages? The first way is to see the direction of the moving averages, and when moving average goes up or grows, you can open positions to buy. So pretty much it works like that. You see a rising moving averages and you buy. You see as moving averages sloping downwards and you sell. Okay. So the next way is when moving averages go smoothly and only a little hesitates. That speaks of the market without trend. Like on this slide, you can clearly see that there is no trend. The price moves ups and down, and the moving average or averages, they intercept and they're staying quite flat, let's see. The next slide shows you how to determine the trend with the help of the order of the moving averages. So on this slide, you basically see two moving averages, the blue one and the red one. The blue moving average is 200 moving average, and the red one is 50-day moving average. 50. It's 4-hour time frame, so it's a period of 50. So if the trend is bullish, the order of the moving averages should be the following. The blue line stays at the bottom, the red line stays in the middle, and the price stays at the top. So it's a clear indication of bullish trend. Blue line in the bottom, red line in the middle, price at the top. Bullish trend. For the bearish trend, let me scroll a little bit down. The order is quite the opposite. 200 moving average or a longer period moving average, let's put it this way, on the top. A shorter term moving average, 50-day moving average in this case, 50-hour, I'm sorry, is in the middle. The price is at the bottom. Okay, that's a clear indication of the bullish trend, bearish trend. And the last but not least is lines interception. So depending on the interception of lights, you can judge the change of the trend. So what we see here is a clear indication of the bullish trend. Then the lines intercepted and the trend changed. So it was bullish and became bearish. Like the bearish trend, for the bearish trend, you see that before, when the trend was bullish, these moving average acted as a support zone. And after the trend changed and the lines intercepted in here, it became resistance. All right. So basically, what I do, I use the moving averages as dynamic support and resistance zones, and also I look for lines interception in order to get the confirmation that the trend is basically changing. So far so good. That's it with the educational part, and now we can go to the practical part of our webinar. But before we start the practical part, let me just really quickly mention that I'm a technical trader, and what you see on the slides is basically technical indicators and price action tools. And I do use them in my trading, but I have to say that even if you consider yourself purely technical trader, you have to watch for fundamentals, because there are fundamentals which you cannot ignore. The fundamentals that create trends, like recent developments regarding Brexit in the UK, or like central banks meeting and the increase or decrease of their interest rates and so on. So what I do offer for you is that we go on the economic calendar, okay, and we watch for the events which will impact the market this week, right? So what I have here is the Forex4you website. You need to open the website if you want to access the economic calendar. Then you go to Analytics, Economic Calendar. You click on it, and what you see is that the web page will open you. Let me see. Nah, that's not a very nice browser. It's blocking me. All right, let me just use another browser. Because the previous browser is basically what it does, it blocks every image I have on the website, and they basically cannot even open the economic calendar. So right now we have a normal browser. We click on Analytics. We go basically economic calendar. All right, the economic calendar will pop up. What you see here is the schedule of all the economic events which will take place this week, right? On Monday, we have all the data released, then on Tuesday, Wednesday, and so on. So what, as I am considered, I consider myself to be a technical trader. I don't use for these low volatility events. And what I do, I filter. I go here, I use only events which have a very high impact on the volatility of the market, and I click filter results. So basically, you see that the economic calendar became much shorter than it was before. And in here, you can take a look at what has already happened, these 4 events. You see here, because they have an actual data, and the events which are going to happen in the recent future. So in here, right, there is my time, but you can adjust your time according to your region in here. time zone. But for me, it's more convenient to use my local time. So what we have on this week, which is not released, ISM manufacturing index, which would affect US dollar and every US dollar connected pairs. We have a Polo's Bank of Canada governor speech today, and also another vote on Brexit. As usual, I would say that I'm get used to votes on Brexit pretty much. It happened last week, 2 weeks before, and in February, in January it happened. So another vote on Brexit we have today. What I want to say is that this vote probably would have an impact on the volatility of British pound and euro as well. So you have to be careful if you're planning to trade those currency pairs today. All right, on Tuesday we have Reserve Bank of Australia interest rate decision and the statement afterwards. Then we have data on the US, ISM non-manufacturing PMI on Wednesday, and on Friday we have non-farm payrolls and unemployment rate for Canada. So non-farm payrolls is basically also affecting the market very, very much, and I would say that you have to watch carefully for this data if you're planning to trade any USD related pair on Friday. So please be aware of it. Now what I offer is to jump to the MetaTrader terminal and analyze live market. Okay, all right. Okay, guys, I see some questions in here. I would like to ask you to ask questions afterwards, after we have the presentation, after we have analyzed the currency pairs I offer. And if you have any questions or any other currency pairs you want me to analyze, feel free to ask, but let's do the major part of the webinar for today, and then I'll be happy to answer your questions. So what we have here is the daily chart of British pound USD. So as you see, a lot of lines in here. Yes, there was a bearish channel, bullish channel, bearish channel, and then there was a pennant, a low wedge, okay, and then kind of a channel, a bearish channel is forming right now for this currency pair. In here, you see that. Let me make it a little bigger, a bit bigger. This one in here. All right, we can jump to 4 hour instead. Like in here, the currency is in the bearish channel. If you take a look at the daily time frame, you see that the 200 moving average. Let me show you. It's 200 moving average. It acts like a very, very nice dynamic support zone. You see the price dropped, found the support in this level, went up, found the support almost at this level, and right now found the support. What I see here as of now is that the price stays in the bearish channel in here. There was some bullish small channel, but overall the trend is bearish, I would say. And you see that the order of the moving averages for some time, it was kind of a bullish, right? The price was like in this case, it was bullish. 200 moving averages at the bottom, 50 moving average in the middle, and the price at the top. But the trend is basically changing. The price went below both moving averages, and the moving averages will soon be intercepted. What's also interesting is that with this yellow color, you see a kind of a wedge in here, and this wedge was broken. You see that last week, right, on the March 28th, it was broken. The price went in here, retested this level, went down again, and now tries to retest this level of the wedge, and at the same time the moving averages on 4-hour time frame, 200 moving average on 1-hour time frame. It's more like a different situation, but in here you see. So basically, what are my expectations as of now? I would suggest you to sell from the current position, right? Let's see. Yes, from the level of 131.20. Okay, with a relatively tight stop loss above the red moving averages. I would put it somewhere on the 60 and also above the local low in here, right? In here, you see the level, and I would put it above a bit, like on the level of 31.65. Okay, which 65. Anyway, and the take profit minimum on the board on the opposite border of the channel. Like that's the first possible way of opening the transaction. Let me put an arrow for you to arrow down. Okay, so we basically sell it from the current rate of 131.20, something like that. We have a 45 pips stop loss, 45 pips stop loss, and the possible 140 pips take profit in this case. If the price triggers your stop loss and goes above to the upper level of the channel, it's also possible to sell it from the upper level of the channel with a relatively tight stop loss. So in this case, we would put a pending sell limit order from somewhere at this area, but it depends on when it achieves this area. So if it's going to be in the near future, it's going to be this level. If it's going to be, let's say, in a couple of days, it would be lower. Now, this relatively tight stop loss of 30, 40 pips stop loss in here, and take profit on the opposite corner of the channel. Okay. So basically, that's how I see this currency pair. So as long as it stays inside the channel, there is an opportunity for you to either buy it from the lower bottom of the channel or sell it from the upper bottom of the channel. But I would also like to pay your attention that right now, probably it's not going to achieve the upper bottom of the channel because there is a wedge line in here, the yellow one, and you see how long it formed. It was formed since the 1st of January, basically. So it's a 3 months line, and it was broken last week. It was retested, and it's been retested the second time. So it is very, very likely that this line will be a sustainable resistance level for the currency pair, and it's a good opportunity for you to sell with relatively short stop loss of 45 pips and a good take profit of 140 pips in here. Okay. Next currency pair is Euro USD. The Euro USD is basically, let's jump on the daily time frame. You can see a lot of lines in here as well. Let me just delete this one. And what we see that the pair is in very consistently bearish channel. The channel was broken in here, but very quickly, pretty much the next day, it returned inside the channel. And right now, you see that the currency is staying in the bearish channel. So the preference should be given to short positions. However, if we take a look at the 1-hour chart, and if we take a look at the indicators and my favorite MACD, what we would see is that there are so many divergences in here. Let me just delete this line and drew a divergence for you. You see on the indicator, the indicator, the next low of the indicator is higher than the previous low. And on the chart, oops, wrong instrument. On the chart, we see that there is a lower low. So it's called a divergence. When the chart demonstrates a lower low and the indicator demonstrates the higher low, that means that probably a correction will start soon, probably, and you have to be careful. What happens next is the indicator forms another higher low, and the price forms another lower low. That's a double divergence. That's a double divergence, and that's a very good indication of the potential correction. What happens next? The chart demonstrates another lower low in here, and the indicator demonstrates another high low. This is a triple divergence. A triple divergence is a very, very likely sign of a potential correction. All right? So probably, even if you see that, you clearly see that there is a bearish trend for Euro USD, but the indication of the triple divergence, it shows you that there is a very high probability that the trend will change. And what we see next is that you see this trend line on hourly time frame, this red bearish trend line. I can highlight it for you. Okay, let's make it bigger. All right, and stretch it a bit. So this line was broken in here, retested, and the price basically went above the moving averages, retested the moving averages, and now is going up. So I would say that there's a very high probability that the trend is changing and the euro will go up. So I would not suggest you to sell euro right now. As well, I would not suggest you to buy euro just because of divergences, simply because the trend is bearish. And you can clearly see that the order of the moving averages on the 4-hour time frame in here and on daily time frame, it confirms the trend is basically bearish, even if the divergence is spotted. So I would say that there are two possible ways of trading this currency pair as of now. So the first one is you wait until the pair goes to the moving average, because this moving average was already broken. There is nothing to do with that anymore, or only if you want to wait until it retests it one more time and you want to buy. That's probably a viable option, but I would suggest you to wait until it touches this level or this level, and to find the selling opportunities from either the 200 moving averages on 1 hourly time frame or the upper channel bottom in here, border. All right, that's my view of the Euro USD right now. The next currency pair is Japanese yen versus USD. What we see on the daily time frame, I especially made it on the daily time frame, that the pair was in the bullish channel, very sustainable, very nice looking one. Then last week, 2 weeks before, it broke the bullish channel and formed a bearish one in here. If we scroll back to a 4-hour time frame, it would be more visually appealing. So the bearish channel was formed in here, then it was broken, and another bullish channel was formed in here. So what we can do in this case, on the daily time frame, there is no special trend on this currency pair, because pretty much last 2 months the pair stays in a very small range of how much is it? 250 pips range for 2 months. That's a very, very small volatility for the currency pair, and on the daily time frame we cannot say that we have a clear indication of either bullish or bearish trend. So that is why we can make decisions based on hourly or 4-hour time frame. On hourly, I would prefer for such a low volatility currency pair, I would prefer an hourly time frame to analyze it. So basically, you see that the bearish channel was broken, a bullish channel was formed. So what we can do, we can go ahead and sell it from the upper bottom of the channel and buy it from the lower bottom of the channel. If this trade is confirmed by the stochastic indicator at the bottom of the working screen. So basically, you can do that. Like in this case, right? There was a confirmation from the stochastic indicator. We could have bought it. In here, there was a confirmation from the stochastic indicator. We could have sold it. So you go from upper bottom of the channel to the lower bottom, from the lower bottom to the upper bottom with a relatively small stop loss. So right now, if the currency pair reverses and touches the upper bottom of the channel, let's imagine it happens somewhere here at the level of 1125. All right, we put a 20 pips stop loss, or even 15 pips stop loss would be enough, I think. 15 pips stop loss, and the take profit on the opposite side of the channel, somewhere here on the level of 110.50, which would basically give you a 15 pips stop loss and a nice 75 pips take profit level. Or you do the opposite when if it drops to the lower bottom of the channel like it did in here. So you basically buy it with also relatively tight stop loss of 15 pips and the take profit on the another bottom of the border of the channel. All right. The next currency pair is Australian dollar USD. So on Australian dollar on daily time frame, you see that the pair was moving downwards for a substantial amount of time since January this year. So it went down. No, I'm sorry, since January 2018. So more like a year. All right. So it was in the bearish channel. The bearish channel was broken in here. It faced a resistance in dynamic resistance zone of 200 moving average. Then it went back, but sharply was reversed. And what it does now, since the beginning of this year, it was staying in the bearish wedge, bouncing up and down, and basically 2 weeks ago this wedge was broken, okay, and right now we can expect the currency pair, I believe, to go upwards because the bearish wedge was broken, and right now the pair forms a triangle. It's more visually appealing to see this triangle on 4-hour time frame. You see the lower bottom of the triangle, the upper bottom of the triangle, and this theory, economic theory, tells you that if the triangle is broken, either way, or up or down, it should go pretty much. Let me just draw this line. The amount of pips, when it breaks down, it should go the amount of pips equal to the amount of pips of the triangle base, like in here. If I consider that if the price breaks the triangle in here, we can expect the currency pair to move to this level. If the currency pair breaks the triangle from this level in here, we can expect it to move in here. So what I would suggest you to do is to wait until the currency pair breaks the triangle and then goes either up or down. If it goes up, you put a very tight stop loss below the triangle border, like 15-20 pips maybe stop loss, and you put your take profit all the way up in here. So let's imagine that in a couple of hours the triangle is broken. So I would advise you to buy when it breaks it with a tight stop loss in here. Let's say it broke it here, we put a stop loss of 20 pips, okay, and the take profit in here. The same works for the opposite way. If it breaks in here, a tight stop loss above the lowest bottom of the channel, and the take profit all the way down to the amount of pips which was given by the triangle base. Okay. You can also try to sell and buy it from the borders of the triangle, but the borders is like 50 pips in here on the range of the triangle. You see that the range is going to make low and low, low and low. So it wouldn't give you a good enough reward ratio. But at the same time, you can try to do that. Like in this case, we have potential of taking 60 pips, around 60 pips take profit. So probably putting a 20 pips stop loss with a 60 pips target is a good one. So right now you can sell, but from here you can buy, but I would suggest you to wait until the triangle is broken and then take action. All right, the next currency pair is gold. So on daily time frame, we see that the gold was staying a very nice looking bullish channel. The bullish channel was very sustainable, but then it was broken and the currency even speeded up going upwards, faced a resistance in here, created a doji candle on top, and then reversed. Right now, what I can say is that the currency is staying in the bearish channel. These red lines show you that there is a bearish channel for the currency pair in here. So inside this channel, you see that a small bullish channel was formed. You can better see it on the 4-hour time frame. Yeah, this bearish channel, big one, the small bullish channel in here. Let me just delete this line for you. A bullish channel, and even this bullish channel was broken, and right now the currency pair is in clear bearish trend. So first of all, on a daily time frame, it's below the moving averages, like the red moving averages at least. Then on 4-hour time frame, it's below both moving averages. On 1-hour time frame, it's also almost below the 2 moving averages, and it's staying in the bearish channel, in this big red bearish channel. So the currency pair is pretty much in the bearish trend. Right now, what I can see is that in last 2 days, in Friday and today, there was a small bearish channel, this one, right, and a triangle. You see these yellow lines. Let me just delete this channel for you, and you see a triangle. So pretty much the triangle and descending triangle was formed. As we know, and I already mentioned it, that if the triangle is broken, and it's clearly broken in here, you can expect the price to go at least the amount of pips which was calculated at the base of the triangle. So you can expect the price to go to this level, to the level of 113.04, somewhere here, and then to look for short opportunities from there. So it's quite possible to expect the price to move up to the 200 moving average support on hourly time frame, and then to start selling with relatively tight stop loss. As well, another resistance would be the upper bottom of the channel, a very nice resistance if it goes up. And also, right, from this perspective, I cannot say that I see bearish opportunities, though I insist that the trend is clearly bearish, but I don't see the bearish opportunities right now. There is a buying opportunity either from this level. You can even go ahead and buy it from the current trade with stop loss below the upper bottom of the triangle, somewhere here. That would give you how much? Like $6 stop loss, which is a lot. But at the same time, the take profit can be, let's draw it one more time. This is the base of the triangle. You put the base in here, and the take profit would be somewhere here. So if you open the trade from the current level of what's the level of 1295, you would need to put your stop loss $6.50 below the current price and the take profit $9 above the current price, which is the correlation risk-reward ratio 1.5 to 1, which is kind of okay. So more or less okay. So it is possible to buy it from the current rate, but at the same time, you can wait if it goes down to these level, at least to the moving averages. That would create you a much better entry opportunity from the risk-reward perspective than the current rate. So it is possible to wait until the price goes back to the moving average, the 50 moving average, and buy it from there. But at the same time, you have to keep in mind that the trend is still bearish, and it's clearly seen on 4-hour time frame that the pair is in the bearish channel, red one, and in the bearish trend, and it's dangerous to buy and to find for bullish opportunities in here. And what you see is that the currency immediately after we analyzed it, and I said to you that there is a possibility for the currency pair to drop to the triangle level, right? Once again, it immediately started dropping. That happens, not always, but it happens. And you see that $2, it even $2.50, it went in a single minute. So even buying rate right now would create a much better perspective from the risk reward ratio than buying it a couple of minutes ago. All right. Yeah, but it's live market. What can you do? All right. Then the next currency pair is a USD CHF, the Swiss franc. The Swiss franc, basically on the daily time frame, we see that there is an ascending triangle forming since 2017, and the price respects this triangle. So right now, from the trend perspective, there is no clear indication of either bullish or bearish trend on the daily time frame. If we scroll back to 4-hour time frame, we can see that the pair right now is forming an ascending triangle, and at the same time a bearish wedge. So I would suggest you to wait until the price faces breaks the resistance or support of this ascending triangle and the wedge at the same time, and then take action. So let's assume that the price broke this upper bottom of the ascending triangle. You can go ahead and take your put your take profit, the triangle base in here, right? And the stop loss a little bit below the upper bottom of the ascending triangle in here. So from risk reward ratio, it would create a good opportunity for you. And from the logic of trading, it would be good entry. Also, if you wait until it breaks the lower bottom of the this triangle, it would stay in the wedge for some time, and it is possible to sell it the same way as we would buy it. So you put a take profit on the lower bottom of the wedge if it breaks the lower bottom of the triangle in here, and the take profit and the stop loss a little bit above the higher the level of the wedge. So right now there is no clear indication of where the currency would go. So you have to wait until it breaks either the lower or upper bottom of the triangle. All right. Then we jump to the USD CAD currency pair. There is, let me go to the, on the daily chart, you can see that the price is staying in the bullish channel, that's for sure. And the trend is basically bullish for the currency pair from the daily time frame perspective. Then scroll on the 1 hour chart and you can see, or in H4 chart, you can see that there is also a triangle forming for this currency pair, and right now the pair is at the bottom of this triangle lower side. So what would I advise you to do is that you can go ahead and buy it from the current trade USD CAD. It has the rate of 133.48. You can go ahead and buy it right now. You put a stop loss below the triangle lower bottom and below the current consolidation area, lowest low of the consolidation area. So right in here, let's assume we are buying it from the current trade. Okay, we put an arrow up because we are buying, and I would advise you to put your take profit on the opposite side of the triangle pattern as well, a bit below the previous high, so just somewhere here. So from the risk reward perspective, it would grade a very nice entry with a 15 pips stop loss and a massive 100 pips take profit. A very nice entry, and probably I would advise you to go ahead and do this entry now. You can also see that there is dynamic support of 200 moving average. You have to keep in mind that probably this moving average would act as a dynamic support like it did right here, but we see that the currency is probably going to continue its bullish run inside the triangle pattern. But if it breaks below the triangle, you have to be careful, because it can be a false break, because there is a 200 moving average resistance zone, and it can break the triangle, go to the moving average support, and then return to the triangle once again. So please be careful if you are planning to sell it from here. All right. The next currency pair is pound Japanese yen. The pound Japanese yen on the daily time frame, it was in the bullish channel for a substantial amount of time, but then it broke the channel and formed kind of an also bullish channel, but with another angle. Like in here, let me just delete this one from here. And you see that the pair right now is still in the bullish channel, but the angle is different. If we go back to 4 hour time frame, you would see that the pair is in this bearish red wedge, and right now it's approached the upper bottom of the wedge in here and faced a resistance in 200 moving average, right, and the upper bottom of the wedge. So you can go ahead and try to sell it from here. So let's assume we're selling from here. The arrow down we put because we're selling. Then the stop loss would be above the previous high, above the upper bottom of the wedge, above the moving average. So somewhere here. And above this as well, so would be okay. So this would give us, let's see, 20 pips stop loss, and the take profit we can put in here. So probably it would give us like 20 pips stop loss and a massive 160 pips take profit, which would be a very nice entry from the risk reward perspective, and as well from the logic of the market. Though you have to keep in mind that right now the pair is in the bullish channel, but it's a small one. It's built on M30 or even M15 time frame, and I do expect the pair to continue its bearish run in the nearest future, or in case the price breaks above the moving average, above the upper bottom of the wedge, right? Then we can expect a bullish move. Then we can expect the pair to go, I deleted the wedge bottom. Okay, that's the wedge bottom. Let's make it a little bit smaller. So if it breaks this wedge bottom and the moving average, it can, and it is confirmed by at least one candle, it can go all the way up. And if it happens, I would consider looking for bullish opportunities in this currency pair. All right, then what the last pair for today is USD, a Euro British Pound. I'm sorry. So what we see here on the daily time frame is also what we see, that the pair is staying in the bearish channel. Yeah, you see this red one in here. So I can make it a little longer for you. Like that. So, and this is a triangle upper bottom. They should stay on the same level, but okay, would be good enough. So there is a bearish trend and a bearish channel for the currency pair. You see that it bounced from the upper bottom, lower bottom, upper bottom, lower bottom. So it bounces up and down in the bearish channel, and at the same time there is a triangle pattern forming on the daily time frame in here, this green one. So basically right now the pair stays in the middle of the triangle. So once again, it is possible to buy it from the lower bottom of the triangle or buy it from the upper bottom of the triangle in hope that it will stay in the triangle for some time. And as well, if triangle breaks, like upside down, if the pair breaks the upper level of the triangle and at the same time the upper level of the channel, because they coincide, it can go all the way up, right? And I would consider bullish opportunities. If it breaks down, it will most likely stay in the channel, and it will most likely continue its bearish run inside this channel. All right, so once again, you either buy it from here with take profit to here, you either sell it in here with take profit on the upper bottom of the channel, or if it breaks, you go all the way up or all the way down if it breaks the triangle pattern. So if we jump to the 4-hour time frame, you basically see the same picture but in more detailed way, the clear bearish channel, the triangle in here, and the pair stays in the middle. Okay, I guess that is clear. Even on 4-hour time frame, inside these channels and triangles, there are some moves like that, which forms special channels in here. But I would suggest you to wait for this big channel to be achieved, the bottom line or the lower line of the triangle channel to be achieved in order to make trading decisions based on that. So far so good. We've analyzed every currency pair I had in mind for today. We finished the educational part and also the practical part regarding the economical news. That is it for today, guys. But if you have any questions, you are more than welcome to ask them, and I'll be happy to do that for you. So if you have questions, type it in the chart questions area. And the question was, the question which I received during the presentation was, how do I draw those lines? How do I find those lines? No, basically, it's very easy to find those lines. Like on this example, or even, it's gonna be Japanese yen daily time frame, even more visually easy to understand. So how do I find those levels, bearish level channels or bullish channels? Basically, what I do is I just look at the chart, and if those I see that the prices are kind of staying in line or between some lines, or I don't see those lines. Let's make a clear chart. Let me just chart window like that, daily time frame. Okay. So you see the chart, there are no lines. But how do you find the lines? Basically, you see like the price behaves, and it's visibly very easy to understand that there is a line which the market respects. So you simply drew a line like that. Okay? Let me just. This is probably not a very nice way. It's like a channel in here. See, like that. So basically, if you see that the price is staying in some small range, and this range is either flat, like it doesn't have any angle, or it has a bullish angle or bearish angle, you simply put those levels on your chart, like in this case, or as well as using the dynamic and support resistance. You don't have to be very smart to see that the price respects the level dynamic support and resistance levels. Like in this case with the British pound, the price went to the 200 moving average, retraced, went back, retraced, went back, retraced. Yeah, it's kind of very easy, and you see that the price respects this line in here, in here, in here. It was broken, but then the price reversed, and when it was broken, retested. You basically take a look at the chart, and you analyze this chart according to simple logic. You take a look at there is probably a resistance or support, and you drew the support. If it doesn't fit, okay, it doesn't fit, you don't draw it. But if it fits, go ahead and throw it. It's just because I see it. I don't know. There is no special hack of spotting those lines on the market. It's kind of the market goes this way, and you drew those lines. Are there any other questions? How does gold perform? All right, guys, I can for sure open a gold chart for you. Yes, and we see that the gold is basically it's going to the lower bottom of the triangle, and we see that probably I told you that gold, when it broke the triangle, right, it should go all the way up to here. So I would expect the gold to go here, and this is probably a very good opportunity for you to buy. Because when we were analyzing the pair 10 minutes ago or 15 minutes ago, the price was here, and I told you that probably it's a good level to buy, but right now it's for sure a good level to buy. You can go ahead and buy it on the level of, what's the current level, of 1291, right? With a tight stop loss, you put it in here of 1280, 89, which is $2 stop loss, and the take profit on the level of 100 at 1304.0350, something like that, which would give you $12 take profit and $2 stop loss. That would be I think nice. So probably it's a good opportunity for you to enter. Okay. Are there any other questions? All right. If not, then we're gonna be finishing the webinar. I would like to say thank you for everybody who visited the webinar. I would like to remind you as well that we have an educational webinar regarding the risk-reward ratio on Thursday, the same time. This webinar started today. So on Thursday, if you're interested in risk-reward and trading psychology, I would advise you to visit our educational webinar. And as usual, next week on Monday, we have a live analysis webinar. So if you like this webinar and you want to see more next Monday, feel free to subscribe to our live analysis webinar next Monday. So far, so good. I wish you a very happy trading week and a profitable week ahead, and hope to see you soon. Bye-bye.